Every month, millions of workers contribute part of their earnings toward retirement. The amounts may appear ordinary: a deduction on a payslip, a contribution from an employer, a promise of income many years in the future. But when these contributions are combined, they become something extraordinary. They can help finance airports, energy networks, apartment buildings, technology companies, and even the acquisition of entire businesses. Across the world, pension assets reached approximately $70 trillion at the end of 2024. That is not simply retirement money sitting in bank accounts. It is capital moving through global markets, influencing companies, infrastructure, employment, and economic growth. And some of that money enters one of the most powerful and most debated areas of modern finance: private equity. But who controls these enormous pools of capital? How can the retirement savings of teachers, nurses, and public employees become an ownership stake in a private company? Why might a pension fund commit money for 10 years or longer? And what happens when the investment succeeds or fails? Today, we're going deep inside the world of institutional investing. We will follow the money from a worker's pension contribution to a private equity acquisition, uncover the roles of limited and general partners, challenge some persistent myths, and explain why decisions made inside investment committees can eventually affect us all. To understand institutional investors, we first need to understand why they exist. For most of history, financial security in old age depended heavily on personal savings, property, family support, or continued employment. As industrial economies expanded, governments and employers began developing more formal retirement arrangements. The underlying idea was powerful. Contributions made during a person's working life could be pooled, invested, and later used to provide retirement income. Pooling changed everything. A single worker might have limited investment options, expertise, and bargaining power, but a fund representing thousands or millions of people could hire professional managers, diversify internationally, and negotiate access to investments unavailable to most individuals. These organizations became part of a broader group known as institutional investors. An institutional investor is an organization that invests capital on behalf of beneficiaries, clients, policyholders, members, or other stakeholders. The category can include pension funds, insurance companies, mutual and investment funds, banks, endowments and foundations, sovereign wealth funds, hedge funds, private market investment firms. As retirement systems developed, two pension structures became particularly important. A defined benefit plan promises an eligible member a retirement benefit calculated using rules such as salary, service, and retirement age. The sponsor must therefore manage assets against future obligations. A defined contribution plan determines how much is contributed, while the eventual retirement outcome depends substantially on contributions, investment performance, fees, and withdrawal decisions. During the 20th century, many pension portfolios concentrated heavily on government bonds and publicly traded shares. But the environment changed. People lived longer. Markets became more global. Interest rates moved through long cycles. Pension obligations grew, and many funds searched for stronger diversification and attractive long-term returns. That search helped increase interest in so-called alternative assets, including real estate, infrastructure, private credit, and private equity. Private equity also evolved. Early forms of private investment included wealthy individuals financing businesses directly. During the 20th century, venture capital and leveraged buyout models developed into a professional fund management industry. What began as a relatively specialized corner of finance became a global system connecting institutional capital with privately owned companies. Today, a pension fund and a private equity firm may sit on opposite sides of the same partnership, but both are working within the same investment chain. Institutional investing does not exist in isolation. It forms part of a much larger ecosystem. At the beginning of the chain are the beneficiaries, workers, retirees, and families whose financial futures may depend on the system. Around them are employers, pension sponsors, trustees, administrators, actuaries, regulators, investment consultants, auditors, custodians, and asset managers. Private equity adds another layer. A pension fund may commit capital to a private equity fund managed by a specialist firm. That firm then uses the pooled capital, often together with borrowing, to acquire or invest in private companies. Those companies employ people, serve customers, purchase from suppliers, and operate within local communities. The chain therefore looks like this. Worker contributions lead to pension assets. Pension assets may fund private equity commitments. Private equity funds invest in companies. Company performance generates or destroys investment value. Investment outcomes ultimately flow back toward beneficiaries. But the process is neither immediate nor guaranteed. Institutional investors must operate within legal and fiduciary frameworks that differ across jurisdictions. A pension trustee cannot responsibly choose an investment merely because it sounds innovative or socially desirable. The decision normally must be assessed against the fund's obligations, governing documents, risk limits, liquidity needs, and duties to beneficiaries. The economic environment matters too. When expected returns from traditional bonds decline, private assets may appear more attractive. When interest rates rise, however, borrowing becomes more expensive. Company valuations may fall, and private equity exits may become harder. Demographics also create pressure. An aging membership can increase benefit payments and reduce the proportion of active contributors. A younger fund may be able to accept longer periods of illiquidity, while a mature fund may need more readily available cash. Regulation, inflation, currency movements, and political expectations can all influence the strategy. Technology is changing the environment as well. Investment teams now use larger datasets, advanced portfolio systems, and increasingly powerful artificial intelligence tools. Yet one challenge remains stubbornly human. How do you make decisions today for financial obligations that may continue for decades? That tension between present uncertainty and future responsibility is at the heart of institutional investing. At its core, a pension fund is a pool of assets intended to support retirement benefits. Its investment strategy normally begins with its liabilities. How much money may be required? When will benefits need to be paid? How sensitive are those obligations to inflation, interest rates, wages, or longevity? Actuaries estimate the future obligations. Trustees or governing boards establish policy. Investment teams and external managers implement the strategy. A pension portfolio may include government and corporate bonds, publicly traded equities, cash and short-term instruments, real estate, infrastructure, private credit, private equity, other diversifying strategies. The exact allocation can vary enormously. A pension fund is not trying merely to achieve the highest possible return. It is trying to produce an appropriate return while controlling risk, maintaining liquidity, meeting regulatory requirements, and paying benefits when they become due. That distinction is essential. An investment can be profitable and still be unsuitable if it creates excessive concentration, uncertainty, or illiquidity. Private equity generally refers to investment in companies that are not publicly traded, or to transactions that take public companies private. Common strategies include venture capital, financing young companies with significant growth potential and substantial risk. Growth equity, providing capital to established companies seeking expansion, often without transferring complete control. Buyouts, acquiring controlling interests in businesses, frequently using a combination of investor capital and debt. Turnaround or special situations, investing in businesses facing financial or operational difficulty. Private equity commonly uses a limited partnership structure. The institutional investors providing most of the capital are called limited partners or LPs. The private equity manager is known as the general partner or GP. The pension fund does not usually transfer its entire commitment on day one. It promises to provide an agreed amount when the manager issues capital calls. This produces several important terms. Committed capital is the amount an investor has agreed to provide. Called capital is the portion actually requested by the manager. Unfunded commitment is the amount that may still be called. Distributions are proceeds returned to investors following income, refinancing, or asset sales. Carried interest is a share of investment profits allocated to the manager under the fund's terms, usually after specified conditions are met. 5-stage investment process. The process can be simplified into 5 stages. Stage 1. Strategy and commitment. A pension fund defines its private markets allocation and evaluates potential managers. It examines the firm's team, strategy, track record, fees, governance, risk controls, and operational capabilities. If the investment is approved, the pension fund signs the fund documentation and makes a legally binding commitment. Stage 2. Capital calls. The manager searches for opportunities. When it needs money for an acquisition, expenses, or another permitted purpose, it issues a capital call. The pension fund must maintain sufficient liquidity to meet that obligation, sometimes with only a limited payment window. Stage 3. Acquisition. The private equity fund invests in a company. In a leveraged buyout, part of the acquisition price may be financed with debt. That borrowing can increase equity returns when the company performs well, but it can also amplify losses and financial pressure. Stage 4. Ownership and value creation. The private equity firm may appoint board members, recruit executives, improve operations, expand into new markets, introduce technology, or complete further acquisitions. Value might be created through genuine growth and efficiency, but outcomes can also be influenced by leverage, cost reductions, changes in valuation multiples, and financial restructuring. Stage 5. Exit and distribution. Eventually, the fund seeks an exit. The company may be sold to another business, transferred to another investment fund, sold to another private equity sponsor, or listed on a public exchange. If successful, proceeds are distributed according to the partnership agreement. But a private equity investment can remain locked up for many years. The timing and value of distributions are uncertain. That is why private equity must be considered as part of the pension fund's overall portfolio, not as an isolated promise of higher returns. Imagine a fictional pension organization called the Northbridge Retirement Fund. Northbridge supports 250,000 current and future retirees. Its board has approved a target allocation of 8% to private equity. The fund is approached by Summit Capital Partners, which is raising $5 billion for a new buyout fund. Summit proposes to acquire established companies, improve their operations, and sell them over approximately 10 years. The presentation looks impressive. The previous fund shows strong performance. The team describes an extensive pipeline and a disciplined investment process. But Northbridge cannot make its decision from the headline return alone. Its due diligence team asks, were the previous gains produced by operational improvement, leverage, or rising market valuations? How much performance came from investments that have actually been sold? Have unsuccessful investments been valued realistically? What fees and expenses will Northbridge pay? Can key employees leave the manager without consequences? How are conflicts of interest handled? What happens if one Summit-managed fund sells an asset to another Summit-managed fund? How much debt is expected at the portfolio company level? Does Northbridge have enough cash to satisfy future capital calls during a market crisis? The team also compares performance with appropriate public market alternatives and evaluates whether the private equity strategy genuinely improves the entire pension portfolio. Eventually, Northbridge commits $150 million. Summit does not immediately take all the money. Over the next 4 years, it calls capital as investments are made. One portfolio company performs exceptionally well after expanding internationally. A second delivers moderate growth. A third struggles because demand falls while interest expenses rise. 8 years later, Summit begins returning proceeds. Was the investment successful? The answer requires more than one number. Northbridge should assess net returns after all fees and expenses, actual cash distributions, the timing of those cash flows, the risk taken to earn the return, performance relative to suitable benchmarks, the effect on portfolio diversification, the accuracy and transparency of valuations, the manager's compliance and governance record, the investment's contribution to Northbridge's long-term obligations. Two common private equity measurements are internal rate of return, or IRR, and multiple on invested capital, or MOIC. IRR is highly sensitive to timing. MOIC shows how much value was generated relative to invested capital, but does not fully reflect how long the investment took. Neither measure should be interpreted alone. Good institutional practice, therefore, involves disciplined selection, diversification across managers and investment years, careful cash flow planning, independent oversight, and continuous monitoring. And it does not end when the commitment is signed. The decision to invest is only the beginning of the governance responsibility. Myth 1. Pension funds are government bank accounts. Not necessarily. Some pension funds are associated with public sector workers, but their assets may be legally separate from ordinary government budgets and governed by specific fiduciary rules. Other pension arrangements are sponsored by private employers, industries, or individuals. Their legal structure depends on the jurisdiction and type of plan. Myth 2. Private equity is one giant investor. Private equity is not a single organization. It includes thousands of firms, funds, and strategies. A venture capital fund supporting early-stage medical technology operates very differently from a buyout fund acquiring mature industrial companies. Treating every private equity investment as identical hides critical differences in leverage, liquidity, governance, and risk. Myth 3. Private equity always outperforms public markets. Some private equity funds have produced exceptional returns. Others have performed poorly. Results vary substantially by manager, strategy, investment period, fees, and measurement method. Fund selection skill matters, and historical performance does not guarantee future success. Myth 4. Private assets are less volatile. Private company valuations often change less frequently than quoted share prices. That can make reported returns appear smoother. But smoother reporting does not necessarily mean lower economic risk. A private company can lose value even when its most recent valuation has not changed. Less frequent pricing may delay the visibility of volatility rather than eliminate it. Myth 5. Pension funds have unlimited time. Pension funds often possess long investment horizons, but they also have benefit payments, operating expenses, and capital commitments. A fund can be wealthy in assets and still face liquidity pressure if too much of its portfolio cannot be sold when cash is required. If a pension fund invests in private equity, the fund is directly selecting and managing every company acquired. What do you think? Pause the video and share your answer in the comments. The statement is generally fiction. A pension fund investing as a limited partner usually selects the private equity manager, not every underlying company. The general partner normally identifies, acquires, and oversees the portfolio businesses, subject to the fund agreement and applicable governance mechanisms. However, larger pension institutions may also make direct investments or co-invest alongside managers. The central debate. Supporters argue that private equity can provide patient capital, experienced governance, and operational expertise. It may help companies expand, modernize, or enter new markets. Critics point to high fees, limited transparency, leverage, conflicts of interest, and the risk that aggressive cost reductions can harm employees, customers, or long-term resilience. Both sides can identify real examples. The more useful question is not whether every private equity investment is good or bad. It is whether a specific strategy creates sustainable value, adequately manages risk, and aligns the manager's incentives with those of investors and beneficiaries. Pension funds and private equity funds are sometimes discussed as though they were direct alternatives. Usually, they are not. A pension fund is an institutional asset owner with retirement-related obligations. A private equity fund is an investment vehicle that may receive capital from pension funds and other investors. Private equity should also be compared with public equity. Public shares usually offer greater pricing transparency and can generally be traded more easily. Private equity may provide greater influence over company strategy and access to businesses unavailable on public exchanges. But it also involves less liquidity, more complex fees, less frequent valuation, and greater difficulty reversing an investment decision. Direct investing offers another alternative. A large pension fund may buy a company or infrastructure asset without relying entirely on an external manager. This can reduce some fees and provide greater control. But direct investment requires experienced teams, sector knowledge, governance capacity, and the ability to manage assets over many years. Co-investment falls between the two approaches. A pension fund invests alongside a private equity manager in a specific transaction, This may lower the blended fee burden, but it can also require quick decisions and create concentration risk. There is no universally superior model. The right structure depends on investment objectives, internal expertise, liquidity, governance strength, costs, and acceptable risk. Rather than asking which investment always performs best, institutions should ask, what combination gives this fund the best chance of meeting its obligations responsibly? Institutional investing has changed significantly, but its transformation is far from complete. Private markets have expanded beyond traditional buyouts. Institutional portfolios increasingly consider private credit, infrastructure, renewable energy, logistics, data centers, and other long-duration assets. Artificial intelligence may change how investors screen opportunities, review documents, model cash flows, and monitor portfolio companies. AI systems could analyze enormous volumes of financial, operational, and market data faster than traditional teams. But faster analysis is not automatically better judgment. Poor quality data can produce misleading conclusions. Proprietary models can be difficult to explain. Automated systems may reproduce historical bias or encourage institutions to place too much confidence in apparently precise forecasts. Technology may support fiduciary decision-making, but it cannot remove accountability. Transparency is also becoming more important. Beneficiaries, regulators, and the public increasingly want to understand how retirement assets are invested, what fees are paid, and what risks are being taken. At the same time, private market structures are becoming more complex. Continuation funds can allow a manager to retain an asset beyond the life of the original fund. Secondary markets can help investors sell private fund interests. Private credit can offer new financing channels outside traditional banking. These developments may improve flexibility, but they may also introduce valuation questions, conflicts, and connections that are difficult to observe. The future will also be shaped by sustainability, climate risk, demographic change, and geopolitical fragmentation. Pension funds invest across long-time horizons. Environmental disruption, technological displacement, and changing populations are therefore not distant theories. They may affect asset values and retirement obligations. The institutions that succeed are likely to be those that combine innovation with discipline. They will need sophisticated technology, but also strong governance. They will need access to opportunity, but also the courage to reject unsuitable investments. And they will need to remember whose capital they are ultimately managing, because behind every billion-dollar commitment are individual workers whose retirement security may depend on decisions they never personally see. Even as markets and technology evolve, the fundamental purpose remains the same: to transform capital entrusted today into sustainable financial security for tomorrow. Today, we discovered that institutional investors are organizations that manage capital on behalf of beneficiaries, members, policyholders, or clients. We learned that pension funds must balance investment returns with risk, liquidity, and long-term retirement obligations. We followed the private equity life cycle, from commitment and capital calls to company ownership, exit, and distribution. We also explored why a pension fund commonly acts as a limited partner, while the private equity firm acts as the general partner responsible for managing the investments. And we challenged one of the most important misconceptions in private markets: less frequent pricing does not necessarily mean less risk. Most importantly, institutional investing is not merely about enormous financial numbers. It is about trust. The money may move through complex funds, international markets, and privately owned companies, but its ultimate purpose remains deeply personal: protecting people's financial futures. So here is our question for you. Should pension funds increase their investments in private markets? Or should retirement assets remain concentrated in more transparent liquid investments? Share your perspective in the comments. Next time on Get to Know, we'll explore sovereign wealth funds, how nations invest for the future. How are these funds created? What do they own? And what happens when financial strategy and national power intersect? If you found this episode valuable, like the video, subscribe to the MP Nerds channel, and share it with someone who wants to understand how the financial world really works. Continue exploring technology, business, governance, learning, and digital innovation across the MP Nerds ecosystem. Visit mpnerds.com. Thank you for watching MP Nerds, where complex ideas become understandable.